All right, learning objective 4 here talks about two very important things. One is reporting those variances. And another very important concept that you need to know about is something called the balanced scorecard. So we're going to look at that. Okay. So first of all, variances are reported to management as soon as possible because these are the real critical things to look at. You know, variances, this is what you were expecting, this is what happened, right? That's a variance. Why did those things happen, right? And that's actually what the management by exception is, right? They're looking at a variance report for the exceptions, right? What went wrong, what went right to a great degree. I mean, if you're off $100 here and there, I mean, it's a variance, yeah, but you're not really that concerned. But, you know, you're thousands of dollars off where you were, what the heck happened here, right? So this is the management by exception. They're looking for the variances and specifically the significant ones, the big ones. They want to know why. They want to know why. So here is a variance report for the purchasing department for Zonic. I really just dislike this name. I wish they'd come up with another freaking name. Anyway, so here the variance report for the purchasing department shows that the materials, the quantity, the price that they actually paid, the standard price that they normally pay, and the price variance, and then the total price variance for all this. So here they have an unfavorable total price variance of $420. So this is something based on the amounts here. That's a significant variance because it doesn't seem like much, but it is. And I'd probably want to know why, what happened. Well, it seems as here, the biggest part of that was the actual price of this material was high, and we depend on that. We use a lot of that material, so that's going to cause your difference there. So so that would be something to look into. Why was it much higher? Well, here's the explanation. It was a rush order, so we had to pay a little extra because it's a rush order. So that might be poor planning, you know, and so we'll see. Is that substantial enough to impact the manager's job or performance? It could. It depends. Depends why it was a rush order. Did they forget? Or literally, did they get a special customer order, say, we need this now? Okay, we'll do it. Well, in that case, you know, it's less concern for the manager. One of the things that variances are used in, believe it or not, is an income statement with variances included. This is only prepared for managers. This is not something, what you learned about income statements was financial accounting. This is something that is reported out, you know, to everybody. It's somewhat public, right? But an income statement that's prepared for management using variances to explain some differences is important because, first of all, your income statement is usually prepared looking at standards. And so clearly, if those standards are not met because you have unfavorable things that might have happened here, you should be explaining that because it affects gross profit. And if it affects gross profit, you can be sure as heck it's going to affect your net income. So in this case, they had a standard gross profit. They were expecting an $18,000 gross profit for this month in June. Well, it actually came in at $15,000, not $18,000. What created that $3,000 difference? Why did they get $3,000 less for gross profit? Well, it was because of these variances. These variances are going to explain. And as you see, because overhead is tied often to labor, this became more than half, actually almost much more like 3/4 of this issue was wrapped up in your labor and overhead costs. So this is something that helps explain why we were expecting 18,000 in gross, but we got 15,000 in gross. And of course, that interferes with your profit margins. As you know, from financial accounting, is a super important thing. You want to have those gross profit margins high, and you want your net profit margin to be high as well. You don't have to do one of those. You do have to read them. I don't think you have to do any of them. I'm trying to make you nervous, but you do have to know how to read them. All right, the balance scorecard. Let's see if we can all keep our balance here. So a balance scorecard, the word balance means that when a company usually gives its report, there's so much focus on all the financial stuff, right? The profitability and liquidity and return on equity and investment, all this other stuff. So almost all the measures we're so used to are all financial measures. A balance report card says, look, we want to present both financial and non-financial measures that better indicate why we're performing the way we are performing as a company and how it's related to the strategic goals. Okay. So the balance scorecard evaluates a company's performance from a number of what we call perspectives. And there are 4 that are listed here. So of course, the most common financial perspective we all kind of know a little bit. But then as you see, there's a customer's perspective and an internal process perspective and a learning and growth perspective. And you're going to see those in a little bit more detail here. So and in your book, by the way, this chart is page 481. If you want to see it up close. But different industries are going to measure things differently in terms of non-financial data, right? So for an automobile company, capacity utilization of the plants, of all their manufacturing facilities, how much do they use? That's basically capacity utilization, right? Are they running all their factories at 50%? Are they running all their factories at 80%? 80% obviously would be better, right, than 50. It might be a measure of success, but it's not technically a financial number, but it does tell you that the company is busy fulfilling orders by building cars, for example. The average age of their property, plant, and equipment, key assets that help them make a living, right? Any strikes or non-strikes. They have good labor relations, things like this. And what about customers? Are they loyal to the brand? What's the statistics of repeat customers? Once they buy our brand of cars and they're looking for a new car, do they come back to us for another one? Or at least stay within the same family? And so those might be measures that are important to automobile companies in that industry. For computer systems companies that are in this particular industry, they might be looking at different non-financial measures. This is all non-financial measures, right? So the number of new products and the stock ownership of employees and how many scientists they have in R&D. All those types of things might be very, very important. For companies in the chemical industry, they might look at other types of issues as well, things like the number of patents and trademarks, because that's something that's really is a measure of innovation in that company, and new products come from those patents. So, that means more growth. That's a good measure. It's not in and of itself a financial measure right now, but it should impact it in the future. Certainly you want your customers to be satisfied and know who you are. For regional banks, they might have a different standard that might be important to them, including, how many ATMs they have in their network for their customers. How many products does the customer use for them? Do they just have a savings and checking account, or are they have a credit card, they have a mortgage loan, they have a car loan, they have other types of things with the bank? How many products are they actually selling the customers? there? Are they satisfied with customer service calls? And then, are they able to not just offer credit cards, but keep those relationships with their credit card holders for a long period of time? So every industry is going to have their own set of non-financial markers that are going to be important to them. So here are the four perspectives listed here. And here are some of the things that they would look at. So from a financial perspective, you understand it's all about the numbers in terms of return on assets and profitability and the credit rating of the company and what is the price of the stock. And are we, increasing our profits per employee so everyone is contributing to the bottom line? Um, that's all financial stuff, and we all kind of know that. The balance scorecard starts adding things. So let's look at the customer perspective, right? How many customers would recommend the product to somebody else, right? How many customers do we keep year to year? Is there customer loyalty? What's our response time to customer requests? Is that getting better? Are they satisfied with it? Do they recognize our brand and how do they feel about that? Right. And are we, even though we're servicing customers, are we keeping that at a reasonable rate? So we have high service at insufficient. So all of these really kind of matter about the customer perspective is where you generate your financial issues. So that's where it's kind of related into this, right? With good customers and they keep coming back and buying more of your product, obviously your financial stuff is going to do better. Well, then there's an internal process to look at. Internally, are you selling defect-free products? So that's related to, I mean, if customers are satisfied and they would recommend products, it's probably because they haven't seen or experienced, products with your company that are defective. They have to return or they have problems with. They don't last a while. Like, oh man, I got to do it again. And so this is an internal process that actually is related to the customer, which of course is related to the financial piece of the company because your customers. That's where your revenue comes from. Your customer. So everything flows from that. How are you using labor? Are your plans accurate? Are you efficient? Things like that. So internally, all of these types of things sort of kind of flow up to making sure the customer has a good um, experience, and thus you have a good financial experience. And then, of course, the very last perspective that's mentioned in the book is learning and growth. Right. So employees staying with the company a long time is good for the company because they've often established relationships with customers. And so it's nice when you walk into a bank or a restaurant or other places and you already kind of know people or there are familiar faces there. Well, if you have people that are leaving all the time, so your employee attrition rate is high, there's always new people who don't know what they're doing and or not used to you and you're not used to them. And customers sometimes kind of get weirded out by that type of stuff. So clearly, making sure your employees stay is important, right? Because you're utilizing your labor well, you're probably servicing your customer better, and that again relates to the fact that your customers are going to keep coming back, bringing their friends to buy your stuff, and financially it'll work out. How many employees are cross-trained? Means, can an employee do more than one thing in one particular area? Um, because the more cross-trained your employees are, the better you're utilizing your labor, the better they can service the customer because sometimes customers have issues that require more than one area to become involved. Well, if you're already cross-trained in all those, you're going to be a very good, valuable resource for that customer. And if they're satisfied, they're going to keep coming back, which is a financial objective. Certainly, you don't want any ethics violations. You want to be seen as a company that's doing well, and you have a moral compass. You're not taking advantage of anybody, whether it's discriminating or taking advantage of customers or selling them bum goods and laughing about it, things like that. Are you training people well? Because a well-trained employee can be utilized better, which can service the customer better, which can then lead to customers keep coming back and more financial thing. And is it a safe workplace? If it's a safe workplace, that's important as well, because again, it affects everything all the way up. So this is a balanced scorecard, in a nutshell. It is a non-financial view that is, well, it balances the financial with the non-financial, but it's linked, as you saw. So which of the following would not be an objective used for the customer perspective of this? Well, earnings per share is strictly a financial measure, has nothing to do with the customer. But certainly the customers who would recommend their product, that's customer based. Customer retention, keeping customers for a long time, that's customer based. And can customers recognize your brand and they feel good about it? Right. Okay, so the balance scorecard as it is an important concept because it's financial and non-financial measures wrapped into one. There's linkages between all of those that you can see. I tried to show you a bit more. So you provide objectives for non-financial measures so they can actually improve things, whether it's improve the product, improve the customer service, customer experience with your product, etc. Everything is about improvement. And of course, it integrates all the goals into a measure that the company can go over. Okay. So there we have it. Do it exercise number 4. You have to go back to page 484. If you go to page 484, this is where this particular example is. And this is a company called Polar Vortex. So it's chilly today, but more is coming. So this corporation experienced the following variances. Material price, 250 favorable. Material quantity, 1100 favorable. Labor price, 700 unfavorable. Labor quantity, 300 favorable. Overhead, 300 favorable. Sales revenue was 1027. Cost of goods sold at the standard was 619. Determine the actual gross profit. So again, you've seen this before. Starts with sales revenue. We subtract out the standard cost of goods sold. This is what they were looking for, a standard gross profit of $40,800. Did they actually get that? Well, we're going to need to put all those variances in to find out for sure. So the variances that you saw here, most of them are favorable, which is good because that means your costs are under control, right? So it ends up being that the total variable variance that is favorable was 1750, which means you're going to be adding that to your standard gross profit. So the actual gross profit was higher than what they were expecting at the standard costs and standard at the standard by much higher. So this is something you could do. It's not very difficult to figure out. And that's the only other thing I think you'll be looking at for work here. So so that is the chapter in a nutshell. How'd you do? Questions?